The financial collapse known as the Great Depression stands as a turning point in American and global economic history, a period when unchecked optimism, speculative booms, and profound structural weaknesses collided violently, leaving a legacy of collective trauma and policy transformation. One of the most critical, yet often underappreciated accelerants of this unfolding disaster was the role played by the Federal Reserve. To fully grasp how the Fed intensified the collapse, it is essential to analyze its policies and decisions in the context of the spectacular ascent and shattering decline that defined the era.
This city
The 1920s, often christened the Roaring
Doesn't
'20s,
it?
were
And
marked
did
by
you see the
technological
dresses in that
marvels and a
window?
deep transformation of daily
Positively
life.
stunning.
The rapid proliferation of automobiles, radios, and electric appliances gave rise to consumer habits that were previously unimaginable, fueling a culture of consumerism and instilling a widespread faith in endless progress. Urban America throbbed with new rhythms, as advertising and installment buying reached even those who might once have been excluded from the new prosperity. Beneath this glittering modernity, the stock market became a central symbol, an arena where fortunes could be made on the rising tide of stock prices, often purchased on margin with borrowed money. As the decade progressed, the swelling markets decoupled from genuine economic output, creating a financial bubble underpinned by precarious credit arrangements, vulnerable agricultural interests, and delicate consumer confidence. At the helm of monetary policy during this volatile period was the Federal Reserve, a relatively new entity still shaping its identity and operational philosophy. Charged with moderating economic extremes, the Fed's leadership was caught between the need to rein in speculative folly in the markets and the economic realities of a nation increasingly reliant on easy credit. Viewing the runaway stock market with apprehension, the Fed responded by raising interest rates several times between 1928 and 1929. In theory, such a move would temper speculative excesses. However, this tightening came as critical sectors, most notably agriculture, were already showing signs of distress. By constricting credit in the name of prudence, the Fed inadvertently choked off the financial lifelines of countless businesses and farms dependent on borrowing. When the inevitable stock market crash arrived in October 1929, the economic environment was primed for crisis. The contraction of credit magnified the initial panic, setting off bank runs and widespread financial contagion. Yet at the moment of greatest need, the Federal Reserve hesitated, failing to lend freely or increase liquidity. This inaction allowed the financial shockwaves to multiply unchecked. Banks failed in droves, and depositors, desperate to salvage their savings, withdrew funds en masse. The absence of federal deposit insurance at the time meant that these waves of bank collapses destroyed not just individual wealth, but the very foundations of local economies. Worse still, rather than reversing course or injecting the necessary liquidity to stem the tide, the Fed permitted the money supply to contract by nearly a third from 1929 to 1933. The consequences of this deflationary spiral were severe. Business could not obtain financing, farmers' debts became unbearable, and consumers found themselves without the means for even basic purchases. Deflation, far from alleviating burdens, increased the real weight of debts and forced waves of defaults, bankruptcies, and layoffs. With each turn of the economic screw, the social crisis deepened, bread lines lengthened, homeless camps expanded, and a sense of helplessness pervaded the national psyche. A further constraint was the international commitment to the gold standard. Obsessive adherence to maintaining gold parity, by raising interest rates to protect reserves, strangled the economy when it most required relief. Instead of providing solace, the gold standard exacerbated the depression, tightening monetary conditions not only in the United States, but across the interconnected global system. As the U.S. contracted its supply of money, nations abroad were compelled to follow suit, spreading deflation and economic disarray, particularly in debt-ridden Europe. This chain of monetary contagion contributed to political upheaval and the retraction of global trade, compounding the worldwide disaster. Domestically, the spiraling collapse pressured the federal government to assert a more expansive role. Under Franklin D. Roosevelt, the New Deal remade the nation's policy landscape, introducing insurance for deposits, regulating financial markets, and injecting a new social safety net, all in response to the shortcomings of existing financial institutions. The legacy of the Great Depression was thus one of institutional reckoning, demonstrating not only the destructive power of monetary inaction, but the necessity for central banks to act boldly during crises. In summary, the Federal Reserve's reluctance and adherence to outdated economic doctrines transformed what might have been a severe but manageable downturn into a systemic collapse. The consequences, economic, political, and psychological, shaped the arc of the 20th century, instructing future generations on the responsibilities of monetary authority.